With so many peer-to-peer lending platforms and types of opportunities available, what are the most important things to consider when investing in the sector?
So it's important for investors to understand when they're looking at investing in peer-to-peer lending is the different sectors that we've got. So consumer lending, where we're lending to individuals who may be borrowing to buy a car. SME lending, small SME lending, where it's a business who's looking to expand. Or asset-backed lending, where there's some type of property or equipment or physical asset that is secured against the loan. Each of those have a different profile in terms of the risk, and you want to look to make sure that you've understood that the interest rate that you're earning for that risk is the appropriate balance to the risk.
It's whom you're giving your money to, because there are huge differences, and despite the regulators putting a lot of energy into a lot of areas, it's just humanly impossible to cover everything. And there are some big gaping holes in the market, and things that have not been defined by best practice, areas where one person is doing it well and somebody else is doing it terribly. So, as I say, it's not an industry, it's a, to use an investor's word, it's a play. You have to decide who you're looking at and who you like best. I mean, if I were putting money in to a P2P platform, number one would be, am I doing this to earn a return on cash as a lender stroke investor? Or am I buying equity or convertible debt as an owner of one of these things? Probably more people do the former. They want, they've got $5,000 or $50,000, they want to find a home for it. I would look for a firm that, despite the guidance from the FCA, does have a provision fund. But I tell you, there is no finance company or bank in the world that would get a firm of accountants to sign off and say they've been operating prudently without a bad debt reserve and provision fund. So any lender that doesn't have a provision fund, I'd be concerned about what happens if something goes wrong. We don't have the FSCS guarantee. We don't have the £85,000. So I'd be very careful. That's the first thing I'd look at. I'd look at the rate. I'd look at the people running it and the experience. Are they all geeks? Do they all come out of a clearing bank? So I'd look at the management. How much are they IT, and how much are they digital, and how much are they lending and banking? I think those would be the main things I'd look at, and then there are probably 10 more things I'd look at more closely before I'd put any serious money into it. Now it's become, given the breakup of the industry into a series of plays, I think it's now become very much like picking a stock, picking a share. You need to analyze the company against its industry and the other players in it and pick it that way. So it's no different.
So investing in peer-to-peer lending, I think, is primarily about getting a better risk-adjusted return for your money. Of course, you can keep it completely safe in the banks up to the banking license limit, but a lot of people are trying to drive some yield and try and get 3, 4, 5% plus return on the money without taking too much risk.
When considering investing in peer-to-peer lending, I would recommend that lenders do some spot checks on the types of lending and the types of platform that they'll be using for that lending. So they really will want to think about whether the track record of the platform is something that they're comfortable with. That'll look different for different investors. They will want to think about what kind of return they're getting and match that, if they can, back to the kind of risk they're taking. It should be the case that the more risk a lender takes, the better the return. And I think it's important for lenders to really understand that. The kind of security that the lender might get will be interesting too, and essentially any other forms of protection that there might be in place. That could be provision funds, it could be insurance arrangements, or it could be the actual security, again, of the loan against a particular asset, which might give the investor some extra comfort. Although I think it's always worth saying that none of those kind of protections are ever a guarantee that you get your money back. There's always some risk associated with peer-to-peer lending. And it's important just that the lenders really understand that. And it varies so much from platform to platform that a little bit of digging up front can really mean that the retail lender understands what they're getting into.